Good afternoon, ladies and gentlemen. Welcome to our section of top funds, where we focus upon quality equity and debt schemes that can help you make good money without spending a lot of time in the market. All that you have to do is buy quality, put in a monthly SIP and relax. All that you have to do is buy quality, increase that SIP by 10-8% each year and reap a windfall in a span of 15-20 years. Of course, the returns are a little less when compared with equity, but there is less risk, less headache, and in times like these, there is less volatility and less pain. Today, we will be discussing the aggressive hybrid sector of Indian funds, which invest their assets under management in 75% equity and 25% debt. In terms of a roaring bull market, the 75% component of equity gives you supernormal returns and debt acts as a cushion. In times like these, since the last 6 months, when you have seen equity markets fall substantially, equity of course corrects, but debt provides a cushion. And when rates are cut in the economy, just as they are now, the debt part of the portfolio gives you supernormal returns. So it is the best of both worlds, and you must always have one aggressive hybrid fund in your portfolio. If you are a beginner, then start with this category. If you are entering the markets just now, this will probably be your best first step on the large street, that you buy an aggressive hybrid fund which gives you the comfort of equity and the debt, and of course the upsides on both sides are always there. When the bull market is roaring, then equity goes up. When it is falling, then it's the debt that provides the comfort. Now let us examine one of the very best funds in the equity hybrid segment, which is ICICI Prudential Equity and Debt Fund. This fund was set up in November 1999. Therefore, we have a history of almost 25-26 years as far as this is concerned. ICICI Prudential Equity Debt Fund is a 5-star fund. Its net asset value for the direct option is 385 rupees. ICICI Prudential Equity and Debt Fund manages 39,886 crores, and as the hybrid category says, about 75%, this is what SEBI mandates, 75% of your equity, of your AUM has to be into equity. In the case of ICICI Pro Equity and Debt Fund, it is 74.6, and the rest is in debt. 21.33% in normal debt, real estate debt is 2.5%, and cash on hand is 1.5%. Now let us examine the returns since this fund was launched. They are to the tune of 15% CAGR each year. This is a wonderful return considering the fact that 25% of the corpus is invested in debt. Now let's look at some other important factors as to why this fund has a superb quality, and that is visible on returns. When you see in its category, the fund is ranked in the upper quartile, which is either its first, second or third over a long period of time. Over a 10-year period, ICICI Pro Equity and Debt has compounded at 13.84%. It has aggressively beaten the hybrid index, as also the Value Research Aggressive Hybrid Index. There are 23 funds in the 10-year period. It stands first. Over a 7-year period and a 3-year and a 5-year period, the fund is ranked second, third consecutively. And when you see the year-to-date performance, and this is the most critical component, which is when the market is falling rapidly, this fund falls less. The year-to-date return on ICICI Pro Equity and Debt Fund is minus 4.1 versus the index fall of 9%. So look at the beauty of this fund. It has fallen half compared with the index. Let's look at the 1 month performance. ICICI Pro and Equity Debt Fund is down 3.8%. The Hybrid Aggressive Fund Index is down 5.6%. Over a 3-year period, again the fund has outperformed the index, falling just 6.5% versus the 10.5% decline on the main index for aggressive hybrids. Ditto for 6 months, 8.53 and 11.32%. So when the markets fall, it falls less than the index, and when the markets rise, it outperforms the index. There is no better quality and thumb rule than what you see here, and this has been done consistently by ICICI Pru and equity debt fund. Now let us see where the money is invested. As I have said, 75% is in equity, and let's look at what that portfolio consists of. There are 93 stocks in ICICI Pru equity and debt. The top 10 holdings are 43% of the AUM. Top 5 stocks are 28% of AUM. Amongst the debt, it's mostly and largely sovereign bonds from the government of India. So there is very little risk, if not zero. And when interest rate cuts happen, bond prices go up because yields go down. So you get a double kick. Now let's look at the top equity holdings. Because this fund is structured for primarily safety, you will see that most equity hybrid funds have a large component of nifty stocks in their holding, and ICICI Prudential equity and debt is no exception. Out of the top 5, you have ICICI Bank, where 6.3% of the assets are deployed. HDFC Bank has 6.3% assets. NTPC, India's largest producer of power, has 5.6% representation in AUM at ICICI Pru equity and debt fund. Ditto for Maruti Suzuki and Bharti Airtel, about 5.21 and 4.45. The other stocks in the top 12 are Sun Pharmaceuticals, ONGC, Avenue Supermarts, Reliance Industries, TVS Motors and Axis Bank, L&T and SBI. So you can well see the top 12-15 stocks are pure nifty stocks where you find relative safety and of course less volatility compared with mid caps and small caps. Now let us pay attention to what debt is there in this portfolio. When you look at the debt component of the portfolio, you find sovereign bonds from the government of India being on the top 3 slots. So you have bonds which are maturing in 2023, 2020, 2034, and of course it has rights, which is real estate investment trust represented by Embassy, as also Mindspace and Samvardhana Motherson International debenture, which expires in 2027. So that's the safety part of ICICI Pru equity and debt fund, and if you step into this, of course please consult an independent advisor. But if you are trying to make a fresh portfolio of equity funds, please do consider hybrid, aggressive hybrids as your entry point, and within that ICICI Prudential equity and debt fund, it's a 5-star fund that merits your attention. There is one more important item I also wanted to mention as far as the returns are concerned. Please allow me a moment. Yes, this is what I was looking at. A 15.78% annualized return essentially means that if you invested 10,000 rupees over the last 25 years into this particular fund, a monthly SIP of 10,000 rupees, your 30 lakh rupees invested over 25 years would have grown by 10 times. They would have been 3 crore 30 lakh rupees. So that, ladies and gentlemen, is the power of compounding. That is the power of a long-term portfolio held over multiple years, and of course the combined safety of quality equity and superb quality debt is what aggressive hybrids give you. So keep in mind ICICI Prudential equity and debt fund. Thank you for watching.
Since September last year, the Bombay Stock Exchange is down about 15%, the Nifty 50 down about 16%, and if we go across sectors, the public sector stocks are down about 45% from their high.